Are we on the verge of a major stock market shift? The answer is complex and multifaceted. There are many factors influencing our economy right now, from global trade tensions to technological advancements. One of the biggest is the Federal Reserve's recent decision to cut interest rates, aiming to stimulate economic growth. This is the third time this year the Fed has taken this action, reflecting ongoing concerns about economic stability. On December 18, 2024, they made a decision that will impact your wallet and financial planning. It's important to understand what this means for you, your family, and your future financial health. This essay will break it down in simple terms, making it easier for you to grasp the implications. We'll examine the economic situation in detail, looking at both national and global perspectives. We'll also look at how this rate cut affects you directly, from your savings to your loans. By the end, you'll have a clearer picture of the financial road ahead, helping you plan more effectively. Knowledge is power, especially when it comes to your money and making informed decisions. Navigating the financial world can feel overwhelming with its constant changes and complexities. There are constant changes and confusing terms that can make it hard to keep up. Let's cut through the jargon together, simplifying the information you need to know. We'll empower you to make informed decisions about your finances, giving you the confidence to take control. The Federal Reserve, also known as the Fed, made a significant decision on December 18, 2024. This decision has far-reaching implications for the economy and affects everyone from large corporations to individual consumers. They decided to cut interest rates, a move that is often used to stimulate economic activity during periods of slow growth or economic uncertainty. This means it will cost less to borrow money, making loans for homes, cars, and businesses more affordable. This impacts everything from mortgages to credit card rates, affecting how much people pay in interest on their existing debts and new loans. But why did the Fed make this move? The decision is part of a broader strategy to manage the economy. The goal is to stimulate the economy by encouraging more spending and investment. Lower interest rates encourage borrowing and spending, which can help boost economic activity. This can lead to economic growth as businesses expand, hire more workers, and invest in new projects. Businesses expand, hire more people, and consumers have more money in their pockets to spend on goods and services. However, this decision isn't without risks. Lowering interest rates too much can have unintended consequences. Cutting interest rates too much can lead to inflation, where the prices for goods and services rise too quickly. Inflation erodes the value of money, making it more expensive to buy everyday items and reducing purchasing power. This erodes the value of your money, making it harder for people to afford the things they need. The Fed has to strike a delicate balance between stimulating the economy and keeping inflation in check, ensuring sustainable growth without overheating the economy. To fully grasp the Fed's decision, we need to look at the bigger economic picture. This involves understanding various interconnected elements that influence the economy. Several factors are at play, each contributing to the overall economic health. Inflation is a major concern. It affects the purchasing power of consumers and can lead to higher costs for businesses. The cost of goods and services has been rising, impacting everyday expenses like groceries and fuel. The job market is another important indicator. Employment levels can signal economic strength or weakness. While it remains strong, there are signs of a potential slowdown in hiring, which could affect future growth. The housing market is also facing challenges. Home prices and availability are critical factors. High interest rates and low inventory make it difficult for people to buy homes, affecting the real estate sector. The Fed must carefully consider all of these factors when making decisions about interest rates. Their policies can have wide-reaching effects. Their goal is to keep the economy stable and growing, balancing inflation and employment. It's a complex task with no easy answers, requiring constant analysis and adjustment. So, let's dive into how the markets have reacted so far. Investors are keeping a close eye on the developments, and the initial reactions have been mixed. Some sectors are showing resilience, while others are more volatile. Now, the political implications can't be ignored either. Policies and regulations are likely to shift, impacting various industries differently. It's a complex landscape, and staying informed is crucial for making sound investment decisions. Moving on, there's a sense of cautious optimism in the air. While challenges remain, there are also opportunities on the horizon. Many experts believe that with careful planning and strategic adjustments, we can navigate these uncertain times effectively. It's about balancing risk with potential rewards, and being adaptable in our approach. In conclusion, it's clear that the current financial landscape is both challenging and full of potential. Staying informed and adaptable is key. Thank you for joining us today. We hope you found this insightful. Don't forget to subscribe for more updates and expert analyses. Until next time, stay informed and stay ahead.